Oil prices are softer this morning as US and Israel are now trying to gain control of the situation in the Middle East, but the big picture remains unchanged. Rising energy prices threaten to push inflation higher across the globe. Central banks are preparing to tighten their monetary policies if needed, and the latter could have an impact on global growth forecasts and not toward the right direction. So welcome to Swissquote's Daily Market Talk. It's Friday, 20th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So a week packed with war headlines and central bank decisions is finally coming to an end with one conclusion. The Middle East conflict intensifies and no one really knows what's the best thing to do with the monetary policies moving forward. What everybody knows, however, is that the rise that we see today in oil and gas prices and energy prices will increase inflation in the short to medium run, depending on the duration and intensity of the conflict, and that will be weighing on growth globally. This is what the Fed, the Bank of Canada, the Bank of Japan, the Reserve Bank of Australia, the ECB, the BOE, and the SNB highlighted this week at their monetary policies. The RBA raised its rates for the second straight meeting, remember, earlier this week to counter inflationary pressures. The Fed preferred to remain cautious this week, with the dot plot still pointing at one rate cut this year, if of course inflation trends toward the 2% policy target, which honestly looks like wishful thinking to me at this point, but who knows. The Swiss National Bank, on the other hand, was lucky enough to have some room to breathe, with inflation in Switzerland nearing around 0%, but the ECB and the Bank of England looked much more concerned than their American peers yesterday, which is quite normal, mind you, because Europeans are net energy importers and their currencies have been depreciating against the US dollar, and that's since the beginning of the conflict in Iran. So inflation could hit Europeans harder than it hits the US counterparts. How hard? Well, one severe scenario laid out by the ECB yesterday, inflation could peak at 6.3% in the first quarter of next year. We all hope it doesn't. Now, happily, the ECB's main forecasts are less extreme than that, though yesterday's updates have been pointing at higher inflation and slower growth for the next 3 years. Yes, next 3 years. Now, if it's any comfort to anyone, ECB President Christine Lagarde said that since the Ukrainian war started, so over the past 4 years, we have learned, we have improved our models, we have changed our strategy, and we are now more attentive to risks around the outlook, she said. Well, it's good for the ECB, but unfortunately it doesn't change the ugly reality that the ECB faces another energy crisis today, and there is one way to deal with the resulting inflation, but it's raising the interest rates. Markets now fully pricing 225 basis point rate hikes from the ECB this year and a 50% chance for a third hike. Voila! That is the ugly conclusion of this week's meeting from the European Central Bank. And the rise in German and French yields will fully reflect the inflation expectations and the rate hike bets for the European Central Bank. German and French 10-year yields have both risen to the highest level since 2011, and the Stoxx 600 index is feeling the pinch as well. The index lost around 2.40% yesterday, but the trigger was not the European Central Bank decision. It was the spike in energy prices, because Brent spiked to nearly $120 per barrel level at some point early yesterday as the war between Iran and Israel hit many oil facilities in the region and damaged them. Oil markets look calmer this morning as US called everyone to stop hitting each other's energy infrastructure, to which Israeli PM responded favorably, and also on news that the US is now considering lifting sanctions on Iranian oil. Yes, what's happening is unbelievable, but it also shows that the US is not really happy with the situation anymore. Meanwhile, France, Germany, Italy, the UK, and Japan said in a joint statement that they will help open the Strait of Hormuz. But to be willing to help is one thing, being able to do so is another. So despite a relatively calmer session this morning in oil and energy markets, the uncertainty and volatility will likely remain on the menu. So the same thinking of volatility and uncertainty also brought the Bank of England to stay pat on its race. At yesterday's announcement, MPC members there anonymously voted to keep rates steady. It's very rare to see an anonymous decision from the Bank of England, so that contrasted with the expectation that the BOE would deliver a rate cut yesterday hadn't the war in Iran happened. Now, more worryingly, but as widely expected and priced in, the Bank of England opened the door for rate hikes down the road to respond to the risk of more persistent effect on UK inflation. Governor Bailey still said he cautions against reaching any strong conclusions about raising the interest rates, but in fine, we all know that if oil and energy prices remain high at the pump, well, the interest rates will have to rise. Now, another bad news is that rising rates will not necessarily counter an external supply shock. It's not going to be extremely effective because higher rates won't end the war in Iran. They won't repair vast damages to the Middle Eastern energy facilities that could take 3 to 5 years to be repaired, some reports say, and they won't bring prices lower. What they will do, however, is to weaken growth, dampen consumption so that the price pressures would be more affordable, more controlled, but hardly reversed. And that's why rate cuts from the European Central Bank are not necessarily looking bullish for European currencies. Both the Eurodollar and cable rebounded yesterday, but they mostly rebounded on the back of a softer US dollar as oil prices retreated after Trump and Netanyahu short joint efforts to try easing pressure in Middle East oil facilities. But this morning, both the Eurodollar and cable are again under some selling pressure. So what's next? Well, no one knows. Even the central bankers don't know. The politicians don't know. Even the God himself doesn't know. But American financial regulators released a package of proposals yesterday to ease regulations for the banks in the US, including lower capital requirements. The latter may help US banks navigate the rising private credit stress more smoothly than otherwise, but would also make them much more vulnerable to another shock, God forbid. But oh well, someone has to do something to give a smile to investors right now, right? So overall, we are approaching another most probably eventful weekend in the Middle East. I wouldn't necessarily expect investors to add more risk to their portfolios today just before the weekend. So I believe that the week will gently die out with this slimmer hope that the joint efforts from Japan and Europeans, US and Israel could lead to some progress in the Strait of Hormuz. But more realistically, oil and gas prices will likely remain under positive pressure, but high volatility could cause sudden price spikes and sharp pullbacks as well. It doesn't mean that oil prices are coming lower. Remember that sharp movements in both sides are cause for concern. So uncertainty will keep investors on their toes until the dust really settles in the Middle East. Now, many pointed at Chinese markets as being less exposed to the Middle East conflict and its worldwide implications for oil and energy prices, as China has vast energy reserves. That's the first thing. They have been investing heavily in alternative energy sources like wind and solar energy, and if all goes really badly, they can reactivate coal. But China has other problems on its own. It's dealing with an aging population, for example, and a deep property crisis. Now, AI and technology has given a boost to Chinese investor appetite, but Alibaba's 67% plunge in its quarterly earnings and a meager revenue growth yesterday sent the share 7% down in New York. The company aims to offset the plateauing e-commerce business by rising AI revenue, and I actually do believe that they have the means to do so, but investors are running out of patience. So let's see what the weekend brings, but this is all for this hectic week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a safe weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.